Welcome to Talker Tickers. So, Hello Group just dropped its Q3 earnings, and it's a real head-scratcher. The headline number looked pretty good, but the stock? It tanked. Today, we're going to figure out exactly what the market saw that most people missed.
All right, so let's get right into the weirdness here. You see, on one hand, a 14% earnings beat. That should be party time, right? But then you look over at the stock price, and it finished the day down over 6%. So what on earth is going on? How does a solid beat turn into a sharp sell-off? That's the puzzle we're going to solve.
Here's how we're going to break it all down. We'll start with those headline numbers, then we'll dig into this tale of two markets happening inside one company. We'll look at the forward guidance that clearly spooked investors, and then we'll compare what management is saying to what the market is doing. And finally, I'll give you our take on the stock.
Okay, first things first, let's just get into the raw numbers for Q3.
Okay, so the whole story really starts to unravel when you look past that shiny EPS number. Yeah, they beat expectations there, and that's great, but look deeper. Revenue? Basically flat. And the real kicker? GAAP net income? That's their actual take-home profit, cratered by 22% year over year. That is the massive red flag that investors grabbed onto, and it just completely overshadowed the good news.
And this really gets to the heart of the matter. Hello Group isn't just one company anymore. It's basically two different businesses under one roof, and they are pulling in completely opposite directions.
And wow, does this chart tell the story or what? I mean, it's crystal clear. Their legacy business in mainland China, it's shrinking, down a pretty significant 10%. But at the same time, their overseas operations are on an absolute tear, exploding with 69% growth. It's a complete tug-of-war.
So, you gotta ask, why the huge split? Well, in China, it's kind of a perfect storm. The economy's soft, so people just aren't spending as much. Plus, there's this new tax policy that's really squeezing their broadcasters, the people who actually create the content. On the flip side, that overseas momentum is just firing on all cylinders. They're making smart buys, like the European dating app Happn, and pushing hard into really fast-growing markets, like the Middle East.
All right, now let's get to the part of the earnings call that really sent a chill down Wall Street's spine. We're talking about the forward guidance.
This is it. This is what really did the damage. Management's own forecast for the next quarter showed the slowdown in China isn't just continuing, it's actually getting worse. They're guiding for a 13 to 15% drop, and even with that amazing 70% growth overseas, it's just not enough. The China business is such a huge piece of the pie that it's dragging the entire company's revenue growth into negative territory. That's a tough pill for the market to swallow.
And then there's this. To stop their best broadcasters from walking out the door in China, the company basically had to give them a raise, a bigger slice of the revenue. Now you might think, okay, what's the big deal? Well, that directly hits their gross margins, knocking them down by 1 or 2 full percentage points. That's a huge deal. It means their core business is becoming fundamentally less profitable.
So what you have now is this classic showdown. You've got the story management is trying to sell, and then you have the story the market is actually buying, or in this case, selling. On one side, you've got management pointing to the future, saying, hey, look over here. Look at this incredible overseas growth engine we're building. But investors, they are not looking at the future, they are looking at the here and now. And what they see is the old cash cow, the domestic business, shrinking and getting less profitable. They see the cash balance going down. And most importantly, they see that weak negative guidance. It's a total disconnect.
All right, so let's put all these pieces together. Where does this leave the stock? What's our call?
When you boil it all down, the question for anyone looking at this stock is pretty simple. It's a race against the clock. Can that new, shiny overseas growth engine get big enough, fast enough, to make up for the decay in their old domestic business before that old business drags the whole company down?
Because of that tension, we're initiating coverage with a market perform rating. It's not a buy, it's not a sell, it's a stalemate. You have this incredibly powerful growth story overseas, but it's being perfectly canceled out by the really significant risks back home. The stock is basically trapped in this narrative tug-of-war, and we think it's going to be stuck in a range until one of those stories decisively wins out.
Now, for those of you who are a bit more aggressive, there is a potential trade here. We're calling it the pivot play. The idea is that the market has overreacted to the bad news from China and is completely ignoring the value of that fast-growing overseas segment. So the play would be to start building a position on any more dips, betting that by the time the next earnings report comes out, the overseas numbers will be so big that the market simply can't ignore them anymore. That could force a re-rating of the stock. Your target would be a move back up to the $8 level. But, and this is a big but, the risk is real. China could fall off a cliff even faster, or that overseas growth could suddenly hit a wall.
And as always, this is not financial advice.